Are you new to investing and don't know where to start? Well, you've come to the right place. Welcome to the exciting world of investing, where the choices you make today can shape your financial future tomorrow. Investing is more than just stashing your money away. It's about growing it, multiplying it, and creating a safety net for yourself and your family. It's about taking calculated risks and reaping the rewards. It's about securing your future and paving the way for financial freedom. In this video, we'll be exploring 5 smart investment strategies that can help you navigate this landscape, even if you're just starting out. We'll talk about the importance of starting early, diversifying your portfolio, making regular investments, understanding your risk tolerance, and staying informed. Each strategy is designed to help you make informed decisions and get the most out of your investments. So, buckle up as we dive into the world of investment strategies. The first rule of investing is to start as early as possible. Let's take a moment to talk about why. You see, when you invest, you're not just putting your money to work. You're also harnessing the power of time. This is where the magic of compound interest comes into play. Compound interest is when the interest you earn on your investment begins to earn interest itself. It's like a snowball rolling down a hill, gathering more and more snow as it goes. The longer the hill, the bigger the snowball. Similarly, the longer your investment has to grow, the more substantial it becomes. Let's illustrate this with a simple example. Imagine 2 friends, Alex and Bailey. Both decide to invest in a mutual fund that averages a 7% annual return. Alex starts investing $100 per month at age 25, while Bailey waits until he's 35 to start investing the same amount. Fast forward to when they're both 65. Alex, who started 10 years earlier, would have accumulated around $400,000, despite only contributing $12,000 more than Bailey. Bailey, on the other hand, would have around $200,000. That's a whopping $200,000 difference, all thanks to starting early and the power of compound interest. So what's the takeaway here? The earlier you start investing, the more time your money has to grow. It's not just about the amount you invest, it's also about how long you let your money work for you. This doesn't mean you need to have a lot of money to start investing. Even small amounts can grow significantly over time. The key is to start as soon as you can. We often hear the saying, time is money. But when it comes to investing, perhaps we should say, money is time. The more time your money has to grow, the more potential it has to multiply. Remember, time is a crucial factor in investments. The second strategy is to diversify your portfolio. Picture this. You're at a buffet with a wide spread of delicious dishes to choose from. Would you pile your plate with just one dish? Of course not. You'd sample a bit of everything, wouldn't you? That's exactly what diversification in investing is like. It's about not putting all your eggs in one basket, but spreading your investments across a range of options. In simple terms, diversification is a risk management strategy that involves mixing a variety of investments within a portfolio. The rationale behind this strategy is that a portfolio of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. Think of it this way, when you diversify, you're spreading the risk across different types of investments, such as stocks, bonds, real estate, commodities, and even cash. If one investment performs poorly, it's likely that another might be doing well, helping to offset the loss. Now you might be thinking, why not just stick to the investments that are doing well? Well, the thing about the financial market is that it's unpredictable. What's soaring today could plummet tomorrow. Diversification helps to smoothen out those rough patches and potentially give you a smoother ride. But here's the thing, diversification is not just about quantity, it's about quality too. It's not about having a lot of investments, but about having the right mix of investments. A well-diversified portfolio can help you achieve more consistent returns over time and reduce the overall risk. Remember, diversification doesn't guarantee against a loss, but it can help you manage the ups and downs of your investment journey. It's like having a safety net, ready to catch you if you fall. In the end, it all boils down to this. As an investor, your goal is not just to make money, but also to manage risk. And diversification can be a powerful tool in your arsenal to help you do just that. Diversification can be your safety net in the volatile world of investments. The third strategy is making regular investments. Let's imagine for a moment that you're a gardener. You have this plot of land and you want to grow a beautiful garden. You wouldn't just toss some seeds onto the ground and hope for the best, would you? No, you'd water those seeds regularly, you'd ensure they get enough sunlight, and you'd weed out any unwanted plants. You'd nurture your garden consistently. Now, let's switch gears and think about your money as those seeds. Similar to gardening, investing is not a one-time event, but a process that requires regular attention and care. When it comes to investing, consistency is incredibly important. Regular investments, regardless of the market conditions, can lead to significant returns in the long run. It's like a snowball effect. The more you put in, the bigger your investment becomes and the more potential it has to grow. Sure, the market can be a roller coaster ride. There will be highs and there will be lows. But if you're investing regularly, you're not putting all your eggs in one basket at a single point in time. You're spreading your investment over a period which can help smooth out the bumps along the way. This is what we call dollar cost averaging. By consistently investing a fixed amount, you'll buy more shares when prices are low and fewer shares when prices are high, potentially lowering your overall cost in the long run. But here's the thing. Just like the gardener who doesn't just water his plants once and forgets about them, you can't just make an investment and forget about it. You need to regularly review your investments, adjust your strategy if necessary, and keep your eye on the prize. So remember, investing isn't a sprint. It's more of a marathon. It's not about timing the market, it's about time in the market. It's not about making a quick buck, it's about building a secure financial future. And the best way to do that? Regular investments. Consistency is key when it comes to successful investing. The fourth strategy is understanding your risk tolerance. Risk tolerance, in simplest terms, is the degree of variability in investment returns that an individual is willing to withstand. Think of it as your financial comfort zone. It's a crucial part of investing because it directly impacts the decisions you make and the investments you choose. Imagine being on a roller coaster. Some people thrive on the thrill of the steep drops and sharp turns, while others might prefer a more tranquil ride. Similarly, some investors might be comfortable risking a potential loss for the chance of higher returns, while others may prefer steadier, more predictable investments. Several factors can influence your risk tolerance. Your age, for example, plays a significant role. Younger investors often have higher risk tolerance as they have more time to recover from potential losses. Your financial situation and goals also matter. If you're saving for a short-term goal, you might not want to risk losing your investment. But for long-term goals like retirement, taking some calculated risks could potentially lead to greater returns. Emotional factors, too, can influence risk tolerance. How comfortable are you with uncertainty? How would you react if your investments declined significantly? These are questions you need to consider. Understanding your risk tolerance is about knowing yourself, your financial goals, and your ability to endure potential losses. It's about balancing your desire for returns with your capacity to remain calm during market fluctuations. Knowing your risk tolerance can help you make smarter investment decisions. The fifth and final strategy is to stay informed. Now, this is more than just a catchphrase. It's a fundamental principle that every successful investor lives by. In the realm of investment, the landscape is always shifting. New trends emerge, market conditions change, and economic indicators fluctuate. This constant evolution is what makes investing both a challenge and an opportunity. So how do you stay informed? It's about building a routine around learning. Start your day by checking financial news websites, following investment blogs, and subscribing to finance podcasts. These resources offer a wealth of information from market updates to expert analysis that can help you make sense of the investment world. But it's not just about quantity. Quality matters too. Focus on reliable sources that provide accurate and timely information. Be wary of sensational headlines or get-rich-quick schemes. Remember, if it sounds too good to be true, it probably is. Staying informed also means understanding the macroeconomic landscape. Factors like inflation rates, GDP growth, and unemployment rates can impact the performance of your investments. By keeping a pulse on these indicators, you can anticipate market movements and make informed decisions. And finally, never stop learning. Attend webinars, read books, join investment groups. The more you know, the better your investment decisions will be. Remember, in the world of investing, your best asset is not just your money, it's your knowledge. And as they say, knowledge is power in the world of investing. And that wraps up our discussion on smart investment strategies for beginners. We've covered a lot of ground today. Starting early, a simple yet powerful strategy that capitalizes on the magic of compound interest. We then delved into diversifying your portfolio, a safeguard against market volatility, and a key to balance risk and reward. Our third strategy highlighted the importance of regular investments, a proven method to grow wealth consistently. We also discussed understanding your risk tolerance. It's crucial to know your financial comfort zone and invest accordingly. Lastly, we emphasized the need to stay informed. Knowledge is power in the world of investing. It's essential to keep abreast of market trends, financial news, and changes in the economic landscape. Remember, the journey of investing is a marathon, not a sprint. Make smart, informed decisions and watch your wealth grow over time.